Hello friends, today we are going to talk about a very important ratio called debt service coverage ratio. This ratio is going to tell you about the solvency of the company in which you're going to invest. It is going to tell you if the company is going to go bankrupt in next 1 year or whether the company has got excess debt on its books. So let's understand what is debt service coverage ratio. So debt service coverage ratio measures operating cash which a company is going to generate versus its total debt obligations, its principal payments plus its interest payments. So the formula to calculate debt service coverage ratio is very simple. It is EBITDA, earning before interest, tax, depreciation and amortization, divided by principal plus interest which a company is going to pay in that time period. So let's take an example to understand this in more detail. Assume gross profit of a company is 100 crores. Its general admin expenses are 40 crores, depreciation is 20 crores, interest payout is 10 crore. Therefore, profit before tax is 30 crores, which is gross profit minus the expenses that we spoke about. It pays tax of 10 crores, so therefore profit after tax is 20 crores. And the total principal payments for the debt, it has taken around 25 crores. Now, let's calculate EBITDA first. So, EBITDA is profit after tax, which is 20 crore. Plus tax of 10 crore plus interest of 10 crore plus depreciation of 20 crore. So total EBITDA for the company is 60 crores. Now against 60 crore of operating cash which this company is going to generate, its total debt obligation is 35 crore, which is 25 crores of principal payments plus 10 crores of interest payments. So if you compare its overall operating cash that it is going to generate, which is 60 crores versus the total debt obligation which is 35 crores, you will see that it has a debt service coverage ratio of 1.71, which basically means that its earnings are 1.71 times its overall debt obligations, which shows that company is in a reasonable position to meet its debt obligations. So higher the debt service coverage ratio, better it is from a company standpoint, from an investment standpoint, because company is going to generate more cash than what it is required to pay its debt obligations. In case this ratio is less than 1, company is at the risk of serious default because company is not going to generate enough cash even to meet its debt obligations. So debt service ratio is a very important ratio that you should look at before you invest in any company, because it is going to tell you if the company is going to default on its debt obligations, if the company is going to go bankrupt, or the company is going to struggle from a debt repayment perspective. Hopefully you have learned something new today. Thank you for watching this video. Jai Hind.